Can nonprofits make a profit? This question often leads to confusion about how these organizations operate financially. Today, we're diving into the world of nonprofit finances to understand how they generate revenue, manage their resources, and navigate the complexities of tax regulations. Nonprofit organizations are entities that primarily aim to serve a public or charitable cause rather than generate profits for private individuals. They're granted tax-exempt status by the IRS and must further religious, charitable, scientific, educational, public safety, literary, or cruelty prevention causes. While nonprofits don't generate profits in the traditional sense, they do earn revenue. This comes from various sources such as donations, membership fees, fundraising events, and sometimes even the sale of goods or services related to their mission. Any surplus revenue in a nonprofit is termed net assets, which is essentially the nonprofit equivalent of profit. However, there's a crucial difference between nonprofit net assets and for-profit company profits. In a nonprofit, this surplus must be reinvested into the organization's mission and operations. It cannot be distributed to individuals or shareholders as it would be in a for-profit company. Nonprofits operate under strict financial guidelines to maintain their tax-exempt status. They must disclose their operational and financial information to the public, typically through annual filings like Form 990 with the IRS. This transparency ensures donors that their contributions are being used appropriately. While nonprofits are generally exempt from income tax, there's an important exception known as unrelated business income tax, or UBIT. This applies to income generated from activities not directly related to the organization's mission. For example, if a nonprofit focused on literacy rents out its facility for events, the rental income might be subject to UBIT. Understanding the distinction between related and unrelated activities is crucial for nonprofits. Revenue from activities directly tied to the organization's mission, like a literacy nonprofit charging for author lectures, is typically tax-exempt. However, income from unrelated activities may be taxed like any other business income. To ensure long-term sustainability, nonprofits often employ innovative strategies for generating revenue. These can include creating social enterprises, forming partnerships with corporate sponsors, building endowment funds, and leveraging digital fundraising platforms. Each of these strategies must align with the nonprofit's mission to avoid risking its tax-exempt status. Financial accountability is a cornerstone of nonprofit operations. Organizations must maintain meticulous records, conduct regular audits, and manage both restricted and unrestricted funds appropriately. This not only ensures compliance with regulations, but also builds trust with donors and the public. In conclusion, while nonprofits can and do generate surplus revenue, their financial management differs significantly from for-profit businesses. The key lies in how this surplus is used, always in service of the organization's mission and public benefit. By understanding these unique financial dynamics, nonprofits can effectively balance their charitable goals with financial sustainability, ensuring they can continue to make a positive impact in their communities and beyond.